Hi, my name is Jennifer Armstrong, and this is my BUS695 capstone project. It is a business plan for fixed assets for XYZ Group. A quick rundown over how it's going to go. We're going to go through the problem with a little background, goals 1, 2, 3, and 4 with some of the objectives, the capital budget, measurements, depreciation, disposing of an asset, and then wrap it all up. So quick background, a couple of years ago, we actually had a position in the finance department whose main job was to do all the fixed assets and capital. But unfortunately, she decided to go another path. So unfortunately, fixed assets kind of took the background. So now that Jennifer was being cross-trained into the position, we were able to get a fresh pair of eyes, and her and Isaac want to make sure everyone has a better understanding about the process, what should and shouldn't be a fixed asset, along with the fact of how to dispose of an asset, and the whole process on how to go from the beginning to the end. There's a lot of steps that are missed nowadays because of turnover and just lack of training. So all of this presentation will be used to fix all of that. Our first goal here is to see if the project proposal makes sense in a financial perspective. Below here, you will see the 4 objectives that we have for that. Quick rundown is that really we're just going to find out what all our current capital projects are, find out which ones are all past due, and just really find out which ones are hitting the capital accounts, and then have a meeting to go over all of that. Our goal too is after we know where we are currently standing with the current assets, we want to actually break down the differences between a CER and an MER, along with have a better understanding of when something needs a corporate approval or an IT corporate approval. All that will actually breaking those all down and providing examples with spreadsheets will actually allow everyone to have a better understanding um, on what they are and help make the approval process quicker. Our third goal is, now that we actually know where all the capital projects stand in the approval process, we want to break down what happens when assets are disposed, and do some asset tagging and tracking, and then do a worksheet for being able to track all those projects. The worksheet for tracking the capital projects is only going to be for finance, so that we can have a better way of tracking where they stand, how much was spent, and the work order that is assigned to it. The other 2 are definitely going to be more for all the departments heads and executives. That's going to be creating a spreadsheet and an outline understanding the disposals and you should be done with them, along with your asset tagging, which is your asset tracking. Right now it is a giant mess, so we need to try and get a better understanding on how and where all those assets are. Now that we completed the first 3 goals, which is all going to help clear up all the asset tracking and assets, our next one is just to make various measurements as of revenue, customer satisfaction, employee satisfaction, and our audits. There are different measurements that are going to take place with that. We should see increases in our employee satisfaction during our employee satisfaction survey. We should see a measurement of increase with our customer satisfaction with our on-time delivery rate. We should also see an increase on our audit performance, now that we are able to find everything that is needed for the audits quicker. We are hoping that we are also going to have an increase in revenue with the fact that we're going to dispose of some of our assets that are no longer in use and hopefully sell those off to other companies. XYZ Group is a public company, so finance is giving their budget from corporate, but their main budget. But there are 2 different budgets that are considered. You have your CER budget and your MER budget. MER budgets are going to go against the department, because they are maintenance. Finance calibrates with the other departments to allocate the budget for maintenance. We use uh, key performance indicators to refine maintenance strategies to allocate the budgets per department. Those KPIs help identify cost trends track progress, and adjust strategies effectively, which help maintain the budget needed per department. When we're looking at our CER budget or capital budget, that involves identifying the cash inflow and the cash outflows rather than accounting revenues and expenses flowing from the investment. Capital investments create cash flow that are spread out over several years into the future. So the timing of the future cash flow is considered and converted to the current period when adjusting the budget. When making the budget, long-term goals are identified with a investment proposal, which is where the CR templates come into play. Our MERs are reoccurring or can be a one-time cost to XYZ Group. These costs are distinct for capital expenditures because it involves the asset to have a longer useful life. Maintenance expenses are expenditures in the same period that they occur, which impacts the P&L, reducing XYZ's group's profit for the year. Finance is there to track expenses to ensure transparency and prevent overspending and prepare a detailed financial report highlighting the IOI, ROI of maintenance effects. Our maintenance is typically done by outside vendors, so who can come and provide the service. So finance does not have any sort of metric to calculate the cost since it is provided us from a vendor. When we're looking at a CER, CERs are recorded as an asset on the balance sheet and are depreciated over the useful life, affecting the income statement. CERs are listed in the investing activities section on the cash flow statements. Capital expenses may be paid in the period when it occurs, but it may also be occurred over some time if the capital expense is related to a development project. Every asset has an estimated life, which helps establish how much the depreciation value will be. No matter how long the estimated life is on that asset, XYZ Group follows a strict guideline. On the left-hand side here is what we are currently following. So no matter what, say business building improvements, those will be depreciated over a 15 years. Depreciation is a tax deduction which helps reduce taxable income and can lead to tax savings, which is why it is important to know where and how the asset is being held up. There are different ways of doing that. You can use a straight line, declining balance, but XYZ uses Bloomberg Tax Fixed Assets software, which is a cloud-based fixed assets subledger that automatically and accurately calculates depreciation. Since depreciation is often excluded from companies' performance because they are not directly related to the ability to generate cash flow, meaning financial objectives, XYZ Group will instead use their EBITDA, which is their earnings before interest, taxes, depreciation, and amortization, to assess performance since it is more directly related to the company's financial health. At the end of the depreciation, the asset can still be used or it can be sold. If it is used, it is still reported on the balance sheet as its cost along with accumulated depreciation with no further depreciation taken, unless there is a repair made that extends the life. If the asset is sold, any profit from the sale is taxable. Here you will see two pictures on your left. This is an example of what the paperwork looks like from the Bloomberg system on depreciation. One's by department and one is by class. Asset disposal is an important concept that is used to remove a long-term asset from the company's accounting records. Proper accounting of the disposal is critical to maintaining updated and clean accounting records. On the right-hand side, you will see an example of what the spreadsheet looks like from Bloomberg. They calculate everything needed to make sure that everything is clean for accounting purposes. Now, there are three different reasons why a asset will be disposed. One of them is that if the asset is fully depreciated, the asset value and the accumulated depreciation must be written off. A company can also dispose of an asset for a sale with a gain. That means that the machine is not fully depreciated, but the company is selling the asset for more than the book value of the machine, so the company gets a gain. Your last one is the company does a disposal of an asset at a loss, meaning the company is selling the asset for less than book value. If the sale of the asset causes a gain or a loss, those are reported on the income statement. Again, XYZ Group uses the Bloomberg tax system to calculate the amount needed for the journal entry so that everything is correct and clean. Now, I want to thank everyone for your time. This is a long process that is going to take some time, from finance to department managers to executive. With a combined effort, XYZ Group could really turn the CapEx fixed assets around and become more organized with a better understanding from everyone. It is, if anyone has any questions, please feel free to ask. Thank you.